Good afternoon and welcome to Chapter 6 of Financial Accounting. We will get started now, even though I'm the only one here. But that's okay. I know sometimes it's easier to watch the recordings than to show up for the live session. So in Chapter 6, we don't have any accounting stuff videos that are really relevant. And I don't have any new announcements for you, so there's really not much to do other than just get directly into our material. In our last couple chapters, we went through the entire accounting cycle. As you might recall, we went through all 9 required steps. And last week we did the closing steps, right? How to close out your books. Well, now we're going to move into more specific aspects of accounting in each particular chapter. In this week, we're going to be looking at merchandising transactions. And hopefully you've read the chapter or watched the recorded lecture. And you know that merchandising is really just a fancy word for retail. So a merchandiser is a company that buys finished products and resells those finished products. So that's what we're going to be talking about how we do accounting for merchandising companies. It is not too complicated, but I think the hard part is remembering the differences in the different methods, because there's a perpetual inventory method and there's a periodic inventory method, and sometimes the account names that we use are different, especially in the journal entries. So that can be a little tricky. The textbook has some really good reminders or charts that you can use to figure out which ones to use. So in fact, it probably wouldn't hurt if I pointed those out. So you can find them in the textbook, but I'm just going to go ahead and open up the PowerPoint for Chapter 6 to show you what I'm talking about, because these are going to be really useful as you go through this chapter. So look for, there are 4 of them, and they look like this. So this one tells you if you're using the perpetual inventory method and you're journalizing things to do with purchasing, then you can use this chart. So the actual purchase, if your company paid with cash, this is what you debit and credit. If your company did not pay, in other words, you purchased on credit, this is what you debit, this is what you credit. Once you make your payment, if you got a discount for paying early, this is what you do. If you did not get a discount, this is what you do. And then if you returned a product, we call that a purchase return. Or if the seller of the product gave you an allowance, meaning they decreased how much you owe, or they gave you some money back because you weren't completely happy with the product, we call that an allowance. So if you get either a return where you return the product or you get an allowance from the seller, before payment, this is what you do. After payment, this is what you do. Okay, so that's the chart to use for the perpetual method with purchase-related transactions. We have also the perpetual method with sales transactions. And then because there's the periodic method of inventory, we've got a chart for periodic with purchases and another one for periodic with sales. So those 4 charts are going to help you if you get stuck and don't remember what accounts to debit and what accounts to credit. Let me just do a quick check and see if there's anything else. Oh yes, I knew that there was something else. This is another helpful graphic that you'll find both in the textbook and in the PowerPoint. Sorry, my phone was ringing, so I'm trying to do 2 things at once. By the way, welcome, Jane. So this graphic is helpful because we are going to deal with some shipping costs, and this will help you remember when the buyer pays for the shipping costs, when the seller pays for the shipping costs. So FOB shipping point, FOB, by the way, stands for freight on board, okay? So just keep that in mind. FOB shipping point means that the buyer is responsible for the shipping costs, and the buyer owns the inventory from the time it leaves the shipper. So as soon as it leaves the shipper, it becomes the property of the buyer, and the buyer pays for the shipping costs. With FOB destination, the property remains the property of the seller until it reaches its destination. And the seller is responsible for the shipping costs, okay? And again, if you can't remember, if you get confused, you could look at this graphic, which is both in the textbook and in this chapter, PowerPoint, sorry. Okay, so those are going to be really helpful for you. We're also going to deal with a couple, sorry, it sounds like there's a jet flying by. A couple different types of discounts. In the chapter, whenever it talks about a purchase discount or a sales discount, what it means is that because the buyer paid within a certain period of time, the seller gave them a discount. Okay, so that's called either a purchase discount if you're the purchaser getting the discount, or it's a sales discount if you're the seller giving the discount. There's also a trade discount, which is a negotiated discount that is negotiated before the sale happens. So there's no special way to journalize it. It's just, that's the price. So whatever the negotiated price is, that is the price of the purchase. So with a trade discount, there's nothing special we have to do from an accounting standpoint. That's pretty much it. So it sounds maybe simple, but it does get a little bit complicated with the two different inventory methods and the fact that a merchandiser is both a buyer because they're buying finished goods and they're a seller that's selling finished goods. That gets a little tricky. You have to think in each situation, is the company that I'm doing the accounting for, are they the purchaser or are they the seller in this situation? Okay. Oh, and then throw in the shipping costs, and that's another complexity. Okay, so let's go ahead and go through it. Oh, welcome, Miguel. So please let me know if you have questions at any point. And if you don't have any now, we're going to go ahead and get started. As it says, you can assume perpetual inventory method unless otherwise noted. Perpetual is more common. With the perpetual inventory method, every time you make a sale, you record the cost of goods sold and how much merchandise inventory you no longer have, so that you always know how much inventory you've sold and how much you still have remaining. That's the perpetual inventory method. That's what most companies use because they like to know how much inventory they have. However, it can take more time, especially if you're manually trying to keep track of it. If you have an automated computer system, it'll track it for you, right? Every time you make a sale, the cash register is just going to keep track of how much inventory you sold, and then you can compare that with how much you have in the warehouse, and you always know how much inventory you've got. But some companies don't have an automated process like that, and they manually have to track their inventory, and they might not have time to keep track of the inventory with every single sale. So instead, they might use the periodic method. And that means that they periodically check to see how much inventory they have and figure out how much they sold. They would probably do that weekly, maybe monthly, depending on how big the company is and how much time they have. So the perpetual method is more common. That's why most of these exercises and problems use the perpetual method. There will be some that specifically state periodic. There's one other thing I wanted to say about that. And of course, oh yes, the other thing I wanted to say was, even if you use the perpetual method, you still, as a company, want to at least once a year, maybe even more often, actually do a physical count of your inventory to make sure that your accounting records are correct. And the reason for that is, even though your automated system should tell you how much inventory you have, what if some got stolen? What if some got lost? What if some got, well, misplaced, I guess would be the same thing. Or what if you've got some inventory that just went bad and you can't use it? So if you periodically check, you can confirm that your accounting records are accurate and then make adjustments if they're not accurate. Okay? So even with the perpetual inventory system, you still need to do a physical inventory count every once in a while. All right, so let's go ahead and get started here. Let's see, how many exercises do we have? We have 19 exercises, and then we're going to go through some of the problems as well. All right, here we go. So the first one, we have a company. Now it says that the company is selling 300 surfboards. So we know that in this case, the merchandising company is the seller in this transaction. And the price of their product is $400 per board. So that is what their customer is paying. And the cost to the company is $140 per board. Now here we see the sales terms. We only have sales terms like this when the customer does not pay, because this tells them when they have to pay by. And it also tells them if they get a discount for paying early. So the way we read these sales terms are $315 net 30. In this case, the buyer gets a 3% discount if they pay within 15 days of the invoice. And even if they don't pay within 15 days, the net amount that is due, so whatever is the amount that hasn't been paid, has to be paid within 30 days. Okay? So $315 net 30 is 3% discount in 15 days. The total is due in 30 days. Now, in these exercises and problems, the invoice date is always the same as the purchase date. In real life, it could be a different date. If it took time, to produce the invoice, maybe the company doesn't do it right away, the seller. But to make it easy, it's just going to be the purchase date. Okay, so here we have to first journalize the initial sale. The company sold 300 surfboards, and the price was $400 each. So that's $120,000 of sales revenue and accounts receivable. Okay. Right? That's nothing new. You've seen that before. And we know that when we record a sale, we also have to record the cost of goods sold. That assumes we're doing the perpetual inventory method. If we were doing periodic, we don't have to record it because we're going to figure it out later. But with the perpetual method, we go ahead and figure it out now. So we take 300 surfboards at a cost of $140 each. So they cost the company $42,000. And our inventory went down by $42,000 because we sold it. Now, let me take this opportunity to remind you, inventory is an asset. It's something we own. So when we sell it, that asset goes down and it gets a credit, right? Because assets decrease on the credit side. At the same time, when we sell that inventory, it becomes cost of goods sold, which is an expense. And expenses increase on the debit side. So we have an expense going up and we have an asset going down. Okay? Anytime we're doing the perpetual inventory method and we make a sale, we have to record not only the sales revenue and either accounts receivable or cash if we got paid cash, but we also have to record the cost of the inventory and we have to reduce our merchandise inventory asset. Okay? So that's the first part of exercise 1. Again, let me know if you have questions. Now for part B, the customer makes a payment. So they made the purchase on March 1st. The invoice was dated March 1st. They had 15 days to pay. So that gave them till the 16th to get the discount. They made their payment on the 10th of March, so they got the discount. And the discount is 3%. Okay, so that's why these numbers are important. So yes, they qualified for the discount and it's 3%. So now what we do, remember that the customer needs to pay us $120,000, right? That's the amount we're expecting to receive. So they pay that off, but they get a 3% discount. So we take the accounts receivable amount times the 3%. Sorry, I did that wrong. The accounts receivable amount is 120,000 times 3%. There we go. So they got a $3,600 discount, right? The amount they owe times the percentage discount. Then what we do is we subtract. So we take the amount that they owed minus the discount that we just calculated, and the difference is what they need to pay, $116,400. And if we wanted to check that, we could add up our debits and we would find they equal our credit. Okay, so those are the steps. Take the amount that's owed, multiply it by the amount of discount, which was 3%, subtract that from the amount owed, and then you know how much has to be paid. Okay, so now we've journalized the customer's payment, and we're done with exercise number 1. Let's try number 2. In this case, we need to fill in the account names. Again, that's probably the harder part of this chapter, is remembering the account names. It does get a little bit tricky. So here in exercise 2, the company is now purchasing. So the company we're doing accounting for is the purchaser in this case, not the seller. They're buying these fax machines at a price of $250 per machine. Okay, well, the numbers have already been calculated for us. So here's the cost of the purchase. We see the purchase terms, which tells us we did not pay cash, right? Because if there are terms, that means we haven't paid yet. Okay, so then, oh, it also tells us up here we made the purchase on credit, which means we haven't paid. Okay, so first thing we have to do is journalize the initial purchase. So we have to think, what do we debit and what do we credit? Well, what we got was merchandise inventory. So we're going to debit merchandise inventory. If we wanted to, we could specify fax machines, but we don't have to because that's also included here in the notes. So that's optional, okay? So we got some merchandise inventory. We have not paid for it. We have to pay for it later. What do we call that? Accounts payable, right? Even though this is really one account we have to pay for because it's from one supplier, but the overall category is accounts payable. So that's how we credit, okay? So that's all we really have to do for the purchase, if we're using the perpetual method, which we are. Then we make a payment on April 17th. So we have to look, did we get a discount? Well, the original purchase was on the 7th of April. We had 10 days to pay, so we add 10 days, and that takes us to the 17th. Now, that's the way it's calculated. If you start counting from the day of the purchase, then the 10th day would be the 16th. But for our class, we don't do it that way. You just add the number of days. So if the invoice was on the 7th, and we have 10 days to pay. We add 10 days, so that gives us till the 17th. And we paid on the 17th, so we do get a 4% discount. How do we figure out the amount of the discount? Again, we take the total that was due. That was the total accounts payable that we are paying off. We multiply that by the percentage of discount. What was the amount? I just hit it. 33,750 is how much we owe, times the 4% discount. So 1,350, that's what we see right here. And we call that merchandise inventory. So we got a discount, but if we're using the perpetual method, all we do is we credit merchandise inventory for the amount of the discount. Why? Good question. Because it reduced the cost of our inventory. So this is what we would have paid if we didn't pay on time. And of course, you never know for sure. If you're going to pay later, you never know for sure that you're actually going to pay on time, right? You hope so, or maybe not. Maybe you plan to pay late. But if you're given a specific discount window, how do you know for sure you're going to pay within that window? So when we make the purchase, we always journalize it for the full price. And then later, if we do pay on time, we reduce the cost of merchandise inventory with the credit for the amount of the discount, if we're using the perpetual method, okay? It's different with periodic. Okay, so the amount of the discount is a credit to merchandise inventory. So what's remaining is cash, right? That's the amount we actually had to pay. So we paid off our accounts payable of $33,750. We only had to pay $32,400 in cash. The rest was a discount, which reduced the cost of our inventory. All right, any questions here on number 2? Feel free, you can put questions in the chat or you can unmute, whatever you're more comfortable with. Not seeing any, let's go to a matching activity here for number 3. So we've got a group of examples over here and terms over here on the left, and we have to match them up. Now, remember that in merchandising, the company could be the buyer or the seller. So if we see consumer, a consumer is an individual person, right? And so we must be the seller in that case. Because if there's a consumer involved, they must be our customer, and that means we're the seller. Okay, so that's a little tip for these, for this exercise. So the first one says a consumer returns merchandise for a full refund. Okay, so we are the seller, and we're giving a refund. That is called a sales return. How do we know? Because the customer returned to us the product and we are the seller, so it's a sales return. Okay, so E gets Roman numeral 1. Number 2 says a retailer receives a partial refund. Okay, so let's think about that. The retailer got a refund, so the retailer must have been the purchaser in this case. They got a partial refund, but they get to keep the defective merchandise. So the word for that is allowance. If we are unhappy with something we purchased and the seller lets us keep what we purchased, but then gives us either a discount on how much we owe or gives us some money back if we already paid, that's called an allowance. And we're the purchaser in this case, so it's a purchase allowance. Okay, So remember, the difference between an allowance and a return is in a return, the product got returned. In an allowance, the product did not get returned. Okay. Number 3, a consumer. Okay, so again, if there's a consumer, we must be the seller. A consumer receives a partial refund but keeps the defective merchandise. Again, if they're keeping the merchandise, this is an allowance. So we are giving them an allowance, and we are the seller, so it is a sales allowance. Number 4, a consumer pays their account in full within the discount window. So I mentioned this earlier. If you pay early and the seller has offered a discount for paying early, we call that a, if we're the seller, it's a sales discount. If we were the buyer, it would be called a purchase discount. So in this case, because there's a consumer, we know we're the seller. The consumer paid within the discount window, so we are giving them a sales discount. Something weird with my monitor. It's weird. I don't know if it shows up funny for you, but it shows up a little funny for me. Okay, number 5, a type of purchase discount negotiated between a manufacturer and a retailer. So as I mentioned earlier, that's called a trade discount. If the two parties just agree on a lower price, or maybe a higher price, but if they agree on a different price ahead of time, that's just called a trade discount. Normally it would be a lower price, right? Since it's a discount. And again, there's nothing special you need to do as far as journalizing those. Then we get to number 6, a retailer returns merchandise. Okay, so the retailer or the merchandiser must have been the purchaser if they're now returning the merchandise. And they're getting a full refund. So this would be a purchase return. So that goes here under B. And the last one has to be D. A retailer, again, a merchandiser, pays their account in full within the discount window. So the purchaser got a discount for paying early, and we call that a purchase discount. Okay, so those are the answers in this order: 3, 6, 4, 7, 1, 5, 2. And we can see it here. 3, 6, 4, 7, 1, 5, 2. Okay, any questions on number 3? All right then, number 4. So let's say we're doing the periodic inventory method and we're waiting till the end of the month to figure out how much inventory we purchased and what was the cost of the inventory that we sold. Well, we have formulas for that. I should probably point those out as well. I think those are back near the beginning of the chapter here somewhere. Where are they? Oh, here they are. Okay. So these are the formulas. Cost of goods sold, you can calculate by taking your beginning inventory. So how much inventory you have at the beginning of the period that's ready to be sold, plus any inventory that you purchased during the period, and then subtract any inventory that's left over at the end of the period, and then you know how much inventory you sold. But wait, Trav, how do you know how much inventory you purchased? Well, good question. Net purchases is your gross purchases, so total that you purchased during the period from your records, minus any purchase discounts that you got for paying early, and then minus any other discounts you got for returning merchandise or because you were not happy with it, even though you kept it, which again is called an allowance. So if you take your gross purchases minus your discounts, returns, and allowances, that gives you net purchases, and you can use that as part of your calculation for cost of goods sold. Okay? So let's use those formulas here. Again, net purchases, we take our gross purchases, 120,400, minus our purchase discounts of 12,450, and then minus our purchase returns and allowances, which are grouped together in one account. And we end up with 84,080 as our net purchases. Okay. So we used these three figures for that calculation. Now we can calculate our cost of goods sold. We take our beginning inventory. So the end of February is beginning of March, right? From an accounting perspective. So we take our inventory at the end of February, which is beginning of March, add the purchases, subtract our ending inventory from March, and we get $203,580. That is the cost of the goods that we sold. Okay, you see that there. So again, it was beginning inventory plus net purchases minus ending inventory is cost of goods sold. And now we can go on to number 5, which is some journal entries. We're going to do first perpetual and then periodic for these journal entries. And really the only difference here in recording these sales is that with perpetual, we have to record the cost of goods sold. And with periodic, we don't, because we'll figure that out later. So let's see what data we have. Oh, I'm sorry, this is not a sale, but it's the same concept. When a customer returns a product, we use pretty much the same journal entry that we would for a sale. It's just that the account names get flipped around, with one exception, and I'll show you what that exception is. Okay, so let's first figure out the customer returned 20 bicycles at a sales price of $250 each. Okay, so 20 bicycles times 250, they returned $5,000 worth of merchandise. And so their accounts receivable goes down by $5,000 because they return the merchandise, they don't owe that money anymore. So that's a credit to accounts receivable. When we made the sale, it would have been a debit to accounts receivable, right? But now they've returned it, so we credit it. And when they first purchased from us, we would have credited sales revenue $5,000. When they return it, we have to debit $5,000. But here's where there's a difference. Instead of sales revenue, we have a separate account called sales returns and allowances. So that allows us to track our gross sales, which is sales revenue, minus sales returns and allowances, and also sales discounts, which is another account, to get to our net sales, right? So that's why we have a separate account for sales returns and sales allowances, just bundled together in one account. The other part of the transaction is we have to reverse the inventory. So again, it was 20 bicycles. They cost us $100 each. Sorry, my cursor is being weird today. There we go, $100. So 20 bicycles times $100 each is $2,000. So that is inventory we got back. So now we have to debit merchandise inventory because it's going up. And our cost of goods sold is going down, right? Since that inventory came back. And so we credit that expense. So again, it's almost exactly the opposite of what we did with the sale. These two accounts got flipped. And these two accounts got flipped, except that sales turned into sales returns and allowances. Okay? So that's how you record a return using the perpetual method. With the periodic method, the only difference is you don't have to record the inventory part. So you notice sales returns and allowances get a debit, accounts receivable gets a credit, just like we had here. The amount's going to be the same. So the only difference is with periodic, we don't have to worry about the inventory. We're going to figure that out later. So we don't record it now. Okay. Let's go on to number 6. Got some journal entries here for a flower company. They are the purchaser. They bought some flowers with cash. So we're just going to debit merchandise inventory and credit cash. Nice and easy, right? We got inventory, we paid cash. In the next transaction, they bought some more inventory. So we'll debit merchandise inventory again. And this time they did not pay. They made a purchase on credit. And we also see what are the terms of the sale. So in this case, we have to credit accounts payable because we're going to pay later, right? Then on October 30th, we actually pay. So the terms were 5/10 net 30. So we would get a 5% discount if we paid in 10 days. Did we pay within 10 days? Yeah, right on the 10th day after the purchase, right? Okay, great. So that means our total accounts payable is going away, but we did not have to pay the full amount. Why? Because of the discount, right? So if we take the amount that we owed, $4,800, sorry, there we go, times the 5% discount, we got a $240 discount. How do we journalize that? Credit to merchandise inventory, right? Because using the perpetual method, that's what we do. Any discounts we get reduce the cost of inventory. And the rest is cash. So if we took accounts payable minus the discount, that tells us how much cash got paid. All right, that's number 6.
I have a question. Sorry.
No problem.
So on the inventory, on the perpetual, the merchandise inventory always gets hit when there's a discount or when product comes back, right? It's just to offset the correct amount of inventory.
If
So
you're
on
the buyer, yeah, if you're the buyer. If you're the seller, it's different. But when you're the buyer and it's perpetual inventory, then whenever you get a discount, it reduces the merchandise inventory cost.
Okay.
Yeah, it gets a little tricky because if you're the seller, it's called a sales discount. But if you're the buyer and you received a purchase discount and you're using the perpetual method, it's a credit to merchandise inventory. With the periodic method, it's a purchase discount. So it depends on whether you're the buyer or the seller and which inventory method you're using. That's why I pointed out those flow charts in the beginning that you can use to try, if you get confused, you can go back and look it up. Okay. So yes, if you're using the perpetual inventory method and you're the buyer, anytime you get a discount, it's going to be a credit to merchandise inventory. Okay. So any further clarification needed, or did that answer the question for you?
No, that helped me.
Okay. Yeah. Okay. Sounds good. If you get stuck, if you can't figure it out anytime, you could always email me as well. but I think you'll find those graphics in the textbook and in the PowerPoint are pretty useful for like, what am I supposed to do in this situation? Especially when it comes to journal entries. Okay, so here we've got another situation. Again, we are using perpetual inventory method and we are the buyer. We buy 24 computers on credit for $560 each. 24 times 560, it's $13,440. Debit to merchandise inventory. And because we haven't paid, it's a credit to accounts payable. Then we returned 5 of them, okay? So 5 computers times $560 each is $2,800. So our accounts payable now has gone down, right? When we made the purchase, our accounts payable went up. And now that we've made a return, our accounts payable goes down. From the purchase, our merchandise inventory went up, and from the return, our merchandise inventory goes down. Right? Because we don't have that inventory anymore. We gave it back. Then we paid the account in full. So let's look at the payment terms. It was $410 net 60. So we would get a 4% discount if we pay within 10 days. That gives us until the 16th. We didn't pay until the 22nd, no discount, right? So we have to pay the full amount. What is that full amount? Well, we originally owed $13,440 minus the $2,800 from the return. Our remaining amount that we owe is $10,640. So that is what we pay. Now, if we did pay in time to get the discount would be on whatever is the remaining accounts payable. So you have to first subtract any discounts that came from returning products or from allowances. And then whatever is the remaining balance in accounts payable, that would be the amount that you got a discount for paying early. But in this case, obviously, we didn't pay early. Okay, so if there are no questions on that one, we'll go to number 8. Losing my voice, talking too much. Not just from this class, just in general. Okay, exercise number 8. Some more general entries for a company purchasing strobe lights. They buy 750 at $23 each. And these are the payment terms. Okay, so let's go ahead and journalize. Oh, actually, we already have the calculation here. So that was the cost of the purchase. Again, it's merchandise inventory. And because they haven't paid, it's accounts payable, right? Okay, then they discover 100 lights are the wrong model. So they return 100 lights and they get I'm sorry, they didn't return them. They kept the lights, but they got an allowance of $8 per light. So they got an $800 allowance. All we have to do to journalize that is the accounts payable goes down and merchandise inventory goes down, right? So it's just flipped from the original purchase. Then we pay on April 30th. So that's 10 days. It's within the 15-day window. We get a 10% discount. So if you take our original accounts payable, $17,250, subtract the $800 allowance we got, that leaves us with $16,450. Then we are getting a 10% discount off of that. And remember, the way we journalize that is a credit to merchandise inventory. And the difference is what we have to pay in cash. Okay. All right, so we have the remaining accounts payable minus the discount that we got, and that's what we have to pay. Welcome, Veronica. We are about to start exercise number 9 for chapter 6. Does anyone have any questions before we go to exercise 9? All right. Okay, so now we are the seller. So in this case, we sold 25 bushels of flowers. They gave us the total, $1,000. So we received $1,000 cash. It's a $1,000 sale, so that's a credit to sales. And remember, if we're doing the perpetual inventory method, we also have to record the cost of the inventory when we make a sale. So that was $700. That's a debit to cost of goods sold, which is an expense. And it's a credit to merchandise inventory because that's an asset that has gone down since we don't have it anymore. So that's how we journalize the sale. Then our client, then we make another sale, sorry. So this time 40 bushels at $30 each, that's $1,200. This time our customer has not paid, so it's an account receivable, but it's still a sale. The cost per bushel to us is $20. We multiply that by 40 bushels, that's $800 cost of goods sold and $800 reduction of our merchandise inventory. Then our client pays for that sale. Now they had 10 days to pay, right, to get a 4% discount. And they did pay within 10 days. Okay, so how much do they owe? Well, originally, actually, it's $1,200, right? There was no return, so they owe us $1,200. So their full $1,200 of accounts receivable goes away. They're getting a 4% discount by paying early. So 1,200 times 4%, they're getting a $48 discount. So notice now, back to your question, Jane, when we're the seller and we're giving a sales discount, it's a debit to sales discounts. If we were the purchaser, it would be a credit to merchandise inventory. Assuming we're using the perpetual method. If we were the purchaser and we're using the periodic method, then it would be a credit to purchase discounts. Okay, it's a lot to remember. But in this case, we're the seller, we're giving the discount, so it's a sales discount, $48. And then we just subtract that from the 1,200, and the customer has to pay $1,152. Okay. All right, so moving on to number 10. Okay, let me try to fit this one on one page here. Okay, we are the seller here. We're selling 10 computers at $870 each. The cost is $560 per computer. Okay, so we've seen this before. It's a sale and the customer is going to pay us later, so it's accounts receivable. It's sales, cost of goods sold, and the last one is merchandise inventory. So this is a pretty common journal entry, right? If you're doing perpetual inventory and you're making a sale, it's going to be debit to accounts receivable unless the customer paid cash, credit to sales or something like that, maybe sales revenue or fees earned if you're a fee-based company. but some sort of revenue account. And then you're going to have debit to cost of goods sold, if you actually sold a product, and credit to merchandise inventory. So if you're a manufacturing company using the perpetual inventory method and your customer has not paid yet, these are the account names that you're going to use. Okay. So there we go. Then on November 14th, the customer returned to computers for a full refund. So again, here we need to flip all those accounts. So those 2 computers times $870, that's $1,740 worth of sales that got returned, right? And when that happens, we know it's called sales, returns, and allowances. And it's also a decrease in the amount that we're going to receive from our customer. So it's a credit to accounts receivable. Now the cost was $560 per computer times 2 computers. So that's $1,120. So that's how much merchandise inventory we got back and how much our costs went down. Okay. So again, the return is pretty much the opposite of the sale, except that the account called sales became sales, returns, and allowances. And the last part, the customer paid. So what were the terms here? It was 510 net 60. 510 net 60. So they had 10 days to pay. The invoice was dated November 7th. That gave them till the 17th. They didn't make it, so they have to pay the full amount. What is the full amount? Well, originally they owed $8,700, right? Then we reduced their accounts receivable by $1,740. So the difference is $6,960. Okay, so that's the amount that the customer paid. So we get cash and their accounts receivable goes down with a credit. Now you can always double check. If we added up the 2 credits to accounts receivable from this customer's transactions, they would equal the 1 debit for accounts receivable. And you can do the same thing when you're the buyer and you have an accounts payable. If you add up any debits to accounts payable, they should equal the credit to accounts payable. Okay. That's a good way to double check your math. Any questions here on this exercise? All right, then moving on to number 11. Okay. So we've got some more sales. In this case, it's 240 strobe lights at $40 each with a cost of $23 each. So let's go ahead and calculate that. 240 times $40 sales price, that's $9,600. Debit to accounts receivable, credit to sales. Then for the costs, because we have to record the inventory costs if we're doing the perpetual inventory method and we made a sale, 240 strobe lights at $23 each. That's $5,520. Debit to cost of goods sold, credit to merchandise inventory. Then our customer discovers 50 of the lights are the wrong color, and we give them an allowance of $10 each. Okay, so because it's an allowance, that means they're keeping it. So they are not returning the inventory. We don't have to reverse any inventory because they didn't return it. But we do have to give them the allowance. So 50 lights times $10 each, we're giving them a $500 allowance. We debit sales, returns, and allowances, because again, we use the same account if we're giving money back or reducing how much they owe from a return or from an allowance. It's the same account. And their accounts receivable is going down since they haven't paid yet. If they had already paid, we would have to give them cash back. Okay. Then they make their payment. So let's see, they had 15 days to pay. Starting with the 9th, they make their payment on the 21st, so they paid within the discount window. What is their accounts receivable? It started as $9,600. We reduced it by $500, so they only owe $9,100, right? We multiply that by the 5% discount. 9,100 times 5% is $455. We subtract that from what they owed, and they paid the difference, $8,645. Okay. Any questions? That is number 11. Okay, we got that right. Very good. On to number 12. Okay, that one just barely fit. Okay, so here we get into shipping costs a little bit. So this is where that graphic I showed you with the FOB destination and FOB shipping point are useful. Veronica, that was before you came on the call, so you can find that either in the textbook or in the PowerPoint for Chapter 6. And that'll be useful to remember who pays for the shipping costs. So in this scenario, on May 10th, this boutique purchases $2,400 worth of merchandise. So they're the purchaser on May 10th. And there are shipping charges of $130 in cash. Okay, so they paid cash for the merchandise and they paid cash for the shipping charges. Because it's FOB shipping point, that means that the buyer is responsible for the shipping costs, so the buyer pays it. Okay. All right, so how do we journalize the purchase? Well, again, it's a debit to merchandise inventory, and because they paid cash, credit to cash. That's how the purchase would be journalized. Now, when you're the purchaser and you're paying for the shipping costs, guess what? You can journalize that the same way, because the cost of shipping is considered part of the cost of your inventory. So you just debit merchandise inventory for the amount of the shipping cost. And if you paid cash, you credit cash. Okay, so it's the exact same journal entry for the purchaser, it's hard to say, the purchaser's shipping costs as it is for the purchaser's purchase. Okay, I just made up a new tongue twister. Okay, now for May 14th, the same company is now the seller. They're selling merchandise. The customer pays with cash. So the company got cash. They made a sale. They have to record cost of goods sold. And they have to record the reduction of their merchandise inventory. But because it was FOB shipping point and the company's the seller in this case, the buyer is going to pay the shipping costs, right? So the seller does not have to worry about it, okay? So you have to pay attention to, is it FOB shipping point or destination? And are we doing the accounting for the buyer or the seller? Okay, any questions there? Let's do another one, number 13. Here, this company's the purchaser. They buy $11,420 worth of merchandise on credit. That's a debit to merchandise inventory. It's a credit to accounts payable. The terms of the purchase are FOB destination. So FOB destination means that the seller pays for the shipping. And in this case, the company is the buyer, right? So we don't need to worry about it. However, on March 30th, they are the seller. Now they're selling the merchandise and it's FOB destination. So in this case, they are going to be responsible for the shipping costs. Okay. I know it gets tricky. That's why you can refer back to that graphic if you need to. So in this case, it's $7,530 worth of merchandise. The cost to the company was $2,860. Now, when you are the seller and you are having to pay for the shipping costs, the way you journalize that is delivery expense. Okay, so this $440 shipping cost is a debit to delivery expense, credit to cash, because they paid cash. Okay, so remember, if you're the purchaser and you're doing perpetual inventory method, the shipping cost is the same as your purchasing journal entry. Debit to merchandise inventory, credit to cash. If you're the seller, it's debit to delivery expense, credit to cash. Okay. And if there are no questions, we'll go on to 14. We're making good time. I think we will be done early today. Okay, number 14. So, oh, that's right. I forgot we have 19 exercises, but I still think we'll be done early. Okay, so let's see. Here, the company is the purchaser, and they paid with cash. So merchandise inventory. Sorry. They paid with cash. FOB shipping point, so the purchaser does not need to worry. Wait a minute. Oh, they do need to worry about the shipping cost because it's FOB shipping point. That's right. So again, that's going to look exactly the same. Debit to merchandise inventory, credit to cash. Now, in the second one, they're the seller. And the customer is paying cash. Okay, so here we got cash. Credit to sales. We have to record the cost of the inventory. So that is cost of goods sold and merchandise inventory. Okay. Now, in this case, we're the seller, but notice the shipping method changed from shipping point when we purchased to FOB destination for the sale. So guess what? We get to pay the shipping costs again. Because remember, shipping point means the buyer has to pay the shipping costs, and we were the buyer in that transaction. FOB destination means the seller pays the shipping costs, and we're the seller in this transaction. So we got stuck with shipping both ways. And remember, we journalize that as delivery expense. If we're the seller, delivery expense, and because we paid cash for the shipping, credit to cash. Okay. All right, number 15. So this one's a little different. We're going to make what's called a multi-step income statement. We can see that here. And it's called multi-step because instead of just sales revenue, it's broken down by gross sales, which is just called sales, minus discounts that we gave to clients who paid early, and then minus any returns and allowances we gave to our customers. And that will give us net sales. Okay. So that gives more detail than normally we've seen in income statements. Then we're going to take out cost of goods sold. That gives us our gross margin. Then we're going to take out our selling and administrative expenses. And then down here on this multi-step income statement, any other revenue that was not from selling our product or service, we include down here. So this is revenue we earned from interest. Maybe we have some investments that are earning interest. So that's a source of revenue for us. And maybe we rented out some property to somebody. So that's another source of revenue, but it's not from our main product or service. So that's down in this category, other revenue and expenses. And then we also had interest expense. That's interest that we owe due to a loan. So when that interest accrues, that's an interest expense. So here we have those revenues and expenses combined together in their own separate category. So it's just a little different from the way we've seen income statements in the past. And this is called a multi-step income statement. So for exercise 15 here, I've put a note. It's easiest if you solve part D before you solve parts A and C. So that's what we're going to do. I guess it's a pretty long exercise. Let me see if I could just get it down to 2 pages. So it'll reduce a little bit of scrolling here. Okay, I think that's 2 pages. Okay. All right, so let's go ahead and start with part D. So part D here asks us first for sales, which again is gross sales, then sales discounts, and sales returns and allowances. So we go up here to our data. Here we see sales. Discounts is 58,040. Oops. Let's get sales returns and allowances. That's just 90,232. So now what we're going to do, and again, the format varies when you're working on income statements. In this case, they're using 2 columns, and that allows us to subtotal these 2 items here, the sales discounts plus the sales returns and allowances. So that's 148,272. I'm going to put that subtotal here. Then when I subtract it from our gross sales, that will give us net sales. $492.91. Okay. So that's our net sales. Then we can subtract cost of goods sold, which we can get up here somewhere. Okay, we see cost of goods sold. That gives us a gross margin, or sometimes it's called gross profit margin, 267,493. Okay. Okay, then the next section here is operating expenses, and that's broken down into selling expenses. So all these have to do with selling, and we're going to subtotal those. This time we're subtotaling in the same column. So again, the format differs sometimes. Then we have general and administrative expenses, and we'll subtotal those. Then we're going to take our total selling and total general and administrative expenses and add them together to get our total operating expenses. Okay. Let me know if you have any questions at any point. So we're going to start here with advertising and marketing expenses. So let's go get those. Here's advertising expense, and marketing is down here, 31,000. Then we need sales salaries expense. That is here. Okay, we'll add up all of these selling expenses. And I get $74,316 is our total selling expenses. And we need depreciation and office supplies. Let's find those. Here's depreciation. Office supplies, 1,600. So we have 3,200, 1,600. Then we need rent expense and insurance expense. Oh, that's rent revenue, not what we're looking for. Here's rent expense. And then we need an insurance expense, 2,450. Okay. Okay, great. Now let's add up all these general and administrative expenses. $22,330. That is our total general and administrative expenses. We'll add that to our selling expenses, and we get 96,646. Okay. Now we can take our gross profit margin from up here, subtract those operating expenses. And we get 170,847. That is our income from operations. In other words, take the amount of revenue from sales minus the costs of goods sold, and then the costs of our operations. And we have an income from operations of that amount. Then we're going to add that interest and rent revenue and subtract the interest expense to get our total other revenue and expenses. So now we go back up here. Let's get interest and rent revenue. Okay, interest revenue is 10,268. Rent revenue, 23,622. Then we need to subtract from those two the interest expense, right? So let's go back up. Interest expense is this amount. Okay. So in this section, it's a little confusing because we have revenues which increase revenue and expenses which decrease our equity, right? So we're going to add the revenues, but then subtract the expense. And the net impact is a $30,213 increase in our equity. 30,213, right? Because revenue increases equity, expenses decrease equity. If it helps, you could put a minus sign here for reference. And that's how we came up with the total revenue and expenses. Now, because that is a positive number, it's increasing our equity, right? So this was the money we made from operations. This is money we made from renting and our investments. So we're going to add those together to get our net income. And we get $201,060. Okay. All of these are dollar amounts, but sometimes in accounting, we don't put dollar signs in front of everything when we think it's fairly obvious. So they usually at least at the start and the beginning. When it's less obvious, when you're dealing with units and you're dealing with dollars, then it's better to identify anything related to dollars with the dollar sign, so people know everything else is not dollars. But anyways, so that's our answer. Let's double check it, but I'm confident that that is correct. Where are we here? Keep going, there we go, okay. Okay, so we solved part D. We got 201,060. However, I forgot we have to go back and do A, B, and C, right? So part A, we've already calculated net sales. If we go to D, remember net sales we determined was $492,091. So we can just put that right there. Now, a simple income statement. This is a more typical income statement from what we've seen in the past. Okay, it starts with net sales. Then you have your rent revenue and your interest revenue. Well, okay, let's go ahead and include those. Rent revenue, interest revenue. So it's all the same information, it's just formatted differently. So the net income is going to come out the same, but just things are in a different order and there's not as much detail in this particular simple income statement. Okay, so in this case, all of our revenue is together at the top. So we get 525,981 as our total revenue. Then we have expenses, cost of goods sold, and then total selling expenses. So cost of goods sold is that, selling expenses, 74,316. General and administrative expenses was this. And then interest expense was 3677. Okay, so in the simple income statement, again, we don't have as much detail. Selling expenses is just one number. General administrative is just one number instead of all the detail. Now we're going to add up all of these expenses. I get $324,921. If we subtract that from our revenues, we should get the same net income we got on the multi-step income statement. So let's see. Yay, it worked, $201,060. Okay, exactly the same thing we saw down here. And then for part C, we just need to put the gross margin, which we already calculated here in part D. So I'll just go ahead and put that in, and we are done with this exercise, okay? So that's what A, B, and C look like. You're gonna have a problem, or maybe a couple problems that are like this one. I didn't mean to say you're gonna have a problem, but there are problems on the problem set like this one where, and I think I included a note in each of those saying to solve the last part first, and then it'll be easier to go back and solve the first part, just like we did here. Okay, any questions on this exercise? Okay, so let's see, we've got a couple more exercises. Okay, now if you notice, this one says we are using the periodic method. So we are doing some journal entries. This company bought 85 bushels of flowers. Oh, for $1,300, they gave us the total. So now here's a difference. With the periodic inventory method, instead of debiting merchandise inventory, we debit purchases. Not exactly sure why, but I guess somebody decided to help keep it straight so that you know whether it's perpetual or periodic, you have a different account name, I don't know. But if you're the purchaser and you're using the periodic inventory method, you debit purchases instead of merchandise inventory. And because we paid cash, we credit cash. Then we make another purchase, 240 bushels. Here we go, 240 at $20 each. We did not pay. So that's $4,800 of purchases, and we have an account payable. Okay, so then when we pay it off, did we get a discount? We had 10 days to pay. We paid on the 10th day, and we got a 5% discount. So 4,800 times 5%, we get a $240 discount. Now, in the periodic method, that is a credit to purchase discounts. Under the perpetual method, it would have been a credit to merchandise inventory, right? But here it's a credit to purchase discounts. And then I guess the reason that they have to do this is so that they can figure out their net purchases. That's why, yeah, that's the answer there. Because remember, to calculate your net purchases, you need gross purchases minus purchase discounts and purchase returns and allowances. And if we recorded everything as, if we recorded every discount as a reduction in merchandise inventory, we wouldn't know the amount of our purchase discounts and allowances. So I guess that's the answer. Okay, but anyways, so we owed $4,800. Because we paid on time, we got a $240 discount. So the difference is we have to pay $4,560 in cash. Okay, let's check that. Yep, that is it. All right, if there are no questions, we'll go to 17. Again, we're still using periodic. So here we bought some computers. That's going to be a debit to purchases. We did not pay, so that's going to be a credit to accounts payable. Then we returned 5 of them. Okay, so that's going to be a credit to accounts payable. And, I'm sorry, a debit to accounts payable, a credit to purchase returns and allowances. Because remember, again, we have to track our total purchase returns and allowances so we can figure out our net purchases. So that's how we would record that. And then when we make the payment, in this case, we did not get a discount. So we paid off, let's see. Yes, we paid off our remaining accounts payable. And that would be a credit to cash, right? Because that's how we paid. Again, if we added up our 2 debits to accounts payable, we would see they equal the credit to accounts payable. So that's a good way to double check and make sure that our math is correct, even though we didn't have to do the calculations for this exercise. Okay, any questions on 17? All right, we've got 2 more exercises and then a few problems. So I still think we'll be done early. 18, we sold 10 tables on credit, okay? We must, it doesn't say it, but we must still be doing periodic because notice we're not recording the cost of inventory. Oh, it does say it here. Use the periodic method. Okay, it just wasn't bold, but it was there. Okay, so 10 tables times $870 each, that would be $8,700, right? So debit to accounts receivable, credit to sales, and we don't have to worry about the inventory since we're using the periodic method. Then 2 of those get returned by the customer. So $870 per table times 2 is $1,740. So now It's kind of like we reverse these two accounts for the return, except that sales becomes sales, returns, and allowances, right? So we debit that, we credit accounts receivable. Then the customer pays, they did not get a discount. How much did they pay? Well, they owed $8,700, right? We can see their original accounts receivable is $8,700 minus the $1,740, we reduced their accounts receivable. So $6,960 is the amount that they pay, right? And one more exercise here. Okay, let's see. So again, it's 240 strobe lights at $40 each. Again, we are using the periodic method, so we don't have to worry about the cost of the inventory. So when we make the sale, the customer has not paid. We see that there are payment terms, which tells us they haven't paid yet. So we have an account receivable and a credit to sales. Then when the customer did they return it? No, we gave them an allowance. So it says here, 50 lights are the wrong color, so we give them an allowance of $10 each. So it's like we flip these two, except sales becomes sales, returns, and allowances. And then we credit accounts receivable, right? Then the customer makes their payment. Did they pay within the discount window? Yes, they had 15 days from the 9th. They paid on the 21st, so yes, they get a 5% discount. 5% of what? Well, originally they owed $9,600 minus $500 for the allowance. So they owed $9,100. Okay, so that's the account receivable that they're paying off. We multiply that 9,100 times the 5% discount. $455 is the discount. Now, how do we journalize that? It is a sales discount. Okay, and that means the rest they paid in cash. So there we go. Let me just point out to you, like I said earlier, we have all those 4 graphics that look like that you can use to keep track of what do you do based on whether it's perpetual or periodic and a purchase or sale type of transaction, right? This one's perpetual for purchases, but we've got 3 others you can use depending on the situation. But I want to show you also this one page. Is this the one? Yeah. Is this the one? Yeah, I think it was. So this one page compares the perpetual inventory method and periodic. So it tells you if you're purchasing inventory, if you're purchasing inventory, you're going to record that to merchandise inventory, right? If you're using the perpetual method. If you're getting an allowance, a return, or a discount, that's reducing merchandise inventory if you're in the perpetual method. When you make a sale in the perpetual method, you have to do both, well, 2 sets of debits and 2 sets of credits, right? Because you're doing the sale, if you got paid, or if it's an account receivable, and then cost of goods sold and merchandise inventory. Same thing with the return. You have to flip all those around and sales become sales, returns, and allowances. If you're only doing an allowance, it's going to be in the perpetual inventory system, it would be debit to sales returns and allowances, and it would be a credit to cash if you're giving the customer money back, or credit to accounts receivable if they haven't paid you yet and you're just reducing how much they owe. And that's the same in the periodic system. The sales discount is also going to be the same in both systems. If you're giving a sales discount, it's a debit to sales discounts, credit to cash if they've already paid, or credit to accounts receivable if they haven't. Okay, so that's the same under both. Now in the periodic system, when you make a purchase, instead of merchandise inventory, you record it to purchases. If you get a return or an allowance, again, it's not merchandise inventory, it would be a credit to purchase returns and allowances in both cases. And if you get a discount, it would be credit to purchase discounts, okay? So this could also be helpful if you get stuck. You could look at this to figure it out. But I know it is a complicated chapter because of all these variations. Any questions here before we move on to these 4 problems? Okay. All right, well, let's go ahead then and open up the problem set, chapter 6. We're going to start with problem number 2. Okay, let's see what we're doing here. This is perpetual inventory method because it doesn't say periodic, so we assume it's perpetual. We've got some sales. Okay, we sold 32 hammers. Okay, so that's going to be, we see credit terms. We know the customer hasn't paid, so that's going to be accounts receivable. Credit to sales. And then because we're doing the perpetual inventory method, we have to do cost of goods sold, right? And merchandise inventory, right? Okay, so that's part A. What's part B? The customer returned 6 hammers for a full refund, okay? So again, it's like we have to flip these around. So sales gets debited, but we call it sales returns and allowances. Accounts receivable gets a credit. Merchandise inventory gets a debit. Cost of goods sold gets a credit, right? Then the customer pays. Well, originally they owed $62.40. We reduced that accounts receivable by $11.70. Oh, what did I forget here? Oh, I'm sorry, we also gave them an allowance. I skipped part C. We gave them an allowance of $200, okay? So the allowance is gonna look exactly like the return, except that there was no inventory, right? In the return, we got inventory back, so we had to reverse the inventory. But with the allowance, we did not get inventory back, so the top part looks the same, and there is no second entry for inventory. Okay, so then when the customer pays, we have now reduced their original $6,240 of accounts receivable by $11.70 for the return, by another $200 for the allowance, and that leaves them $4,870 that they need to cover, right? So that is their remaining accounts receivable. We multiply that by the 10% discount because they did pay within 10 days. Okay. And we are going to call that sales discounts. And the, oh, sorry, that gets debited. So I wasn't supposed to indent that. And the difference is cash, okay? So there we go. Any questions on this problem? So I think next is number 4. Okay, and then 9 and 11. So here's number 4. Okay. Let's see. So first we're going to use perpetual for part A, and we'll use periodic for part B, just for practice, right? Companies would really only use one or the other, but for this problem, we're going to use both. Okay, perpetual inventory, a customer purchases 50 pairs of crutches at $20 each. Obviously, we are the seller in this scenario. We see the cost is $8 each. We see the payment terms. That tells us the customer has not paid yet. Okay, so how do we journalize this? It's an account receivable. It's a sale. We have to record cost of goods sold and merchandise inventory, right? Okay, so there's our perpetual sale. Then they make a return. They return 9 pairs of crutches for a full refund. Okay, so 9 pairs. Again, we're reversing this transaction, so it's sales, returns, and allowances. Yeah, I spelled that right. Accounts receivable is going to get a credit. Cost of goods sold is going to get a credit. And merchandise inventory is going to get a debit, right? So there's the return. And then the customer makes their payment. So $1,000 minus 180, they still owe 870. They paid within the discount window. So they get a 5% discount. That saves them $41. So that is sales discount. Sometimes you'll notice sales discount happens first and cash happens second. It really doesn't matter which order you put them in. But because we have the numbers to go by, we know that the first one was the sales discount and the second one was the cash. Okay. So we've completed part A, the perpetual. Now let's do part B, periodic. For the sale, the first part of the transaction is exactly the same, but we don't need the second part. All right, so I'm just going to copy and paste the first part. For the return, same thing. The first part is the same, and we don't need the second part because we're not tracking the inventory. And for the payment by the customer, the whole thing is the same. Okay. So for periodic, that's what it should look like. I'm going to double check and make sure I'm not imagining things here. This is problem 4. I don't know why that works sometimes and doesn't work other times, but sometimes it doesn't work. So I have to scroll to find the right problem. Okay, here we go. So going down to periodic, we had accounts receivable and sales, exactly what we had before. Sales returns and allowances and accounts receivable. Sales discount, cash, accounts receivable. Okay, Exactly right. So we are done with problem number 4. Okay, any questions? Next, we have 9 and 11. So let's go to those. 8, 9. Okay, number 9. 45 chairs purchased on credit at $55 each. 2,475. 2,475. Then shipping charges are $3 cash per chair. Okay, and it's FOB shipping point. So as the purchaser, we are responsible for the shipping costs. So again, it was 45 chairs times $3 each, $135. Remember, when you're doing the perpetual inventory method, the shipping cost increases your merchandise inventory costs. So we just debit merchandise inventory. Then for August 7th, we buy another 30 chairs at $50 each. And this time it's FOB destination. So this time the seller is taking care of the shipping costs. We don't have to worry about it. And so we don't have to journalize it either. So we had $1,500 as the cost of the chairs. And that's all we have to do. Then we pay for our August 3rd purchase, okay? So we're gonna have to pay this $2,475. Oops. Okay, looks like we're getting a discount. We had 10 days to pay. We paid within that window, so we get a 4% discount. 2,475 times 4%. We get a $99 discount. Remember, with perpetual inventory, we record that as a credit to merchandise inventory. And then we pay the difference, $23.76. Okay. So that's problem 9. If there are no questions, we'll go on to our final problem, number 11. I can see number 10 is one of those where you're probably going to want to do the multi-step income statement first. Did I recommend that up here? I didn't. It does say here when you're calculating gross profit margin, round it to the nearest hundredth. But just keep in mind, if you do part, in this case, it's part E first, then it's going to be easier to go back and do A, B, C, and D. Okay. We'll do number 11 here together. And a lot of scrolling on this one. Maybe I should just reformat these sometime. So the only reason I haven't done that is in case somebody wants to print them out so that they don't end up using too much paper. Okay, so problem 11. Okay, at least it fits on 2 pages here. So we're going to start with part E, and then we'll do the other parts. So we'll start with the multi-step income statement. The first thing we need is our gross sales, which is just called sales. Okay, so let's start with that. Okay, oh, it's already here. I forgot. On this one, we've got the numbers and we need to fill in what they are, okay? So if that's our gross sales, this is probably sales discounts. And this is probably sales returns and allowances. Let's double check that just to make sure. Sales returns and allowances, yes. And sales discounts, yes. Okay. All right. So as we know, we can add those together to get our total sales, discounts, returns, and allowances. We subtract that from our gross sales, and that gives us what? Net sales, right? From that, we can subtract cost of goods sold, and that gets us our gross margin or gross profit margin, either way. Okay. And then from that, we're going to subtract our operating expenses, and that's separated into two categories. So this whole section is operating expenses. The first category is selling expenses. Okay. And then at the bottom of that, we're going to have total selling expenses, or that, oh no, I'm sorry. It goes right here, total selling expenses. Okay, that's going to be this total. Under that, we're going to have general and administrative expenses. That's a long thing to type. And at the total, that is going to be total general and administrative expenses. And then below that is going to be total operating expenses. Okay. So it's broken down into multiple steps here. Let's go ahead and fill in what these expenses are. So we're looking for 11,878 and 26,750. Okay, there's the 11,878. And the 26,750, that's sales salaries expense, okay? So advertising expense, and then sales salaries expense. And that makes sense because those are both related to selling, right? So this whole section is selling expenses. Then we will go to general and administrative. We're looking for 8560 and 4903. 8560 is this depreciation. And 4903 is office supplies. So let's plug that in. The last two are 10,400 and 3421. So it's rent expense and insurance expense. Okay. So now we have all of our general and administrative expenses together. We take the selling expenses plus the general and administrative expenses. Together, they equal our total operating expenses. We subtract that from our gross profit margin, and we call that operating income. Okay. The next section is called other revenue and expenses. So we have two types of revenue we can see here because they're positive numbers. And then this expense is written as a negative number. Sometimes it's not, and you just have to remember that it's decreasing. But here they made it easy for us and they put it in parentheses. So let's see what these are from. The 100,976, that is interest revenue, and the other one is rent revenue. And then the 3,570, I'm pretty sure that's interest expense. Let's just go take a look. Yeah, interest expense. Okay. Interest expense. Okay, so we add together our two types of revenue here, subtract the expense, we get a total. So that is total other revenue and expenses. We subtract that total other revenue and expenses from our operating income, and we get our net income. Okay. There we go. So now we've done part E of problem 11. I still think we'll finish early, though not that early. Net sales, that's part A. So net sales we calculated here already. We can copy and paste. Gross profit, we got that already. Gross profit is same as gross profit margin. Okay, now to get gross profit margin ratio, what we do is we take our gross profit margin or gross margin, we divide it by our net sales. And then, as it said in the instructions, round off to the second place after the decimal point. So it's going to be 0.67, also known as 67%. But if Canvas asks you what's the gross profit margin ratio, put 0.67. Because if you put just 67 or 67, it's going to be wrong. It has to be 0.67. Okay? Because that's the only way you can enter a percentage into Canvas, into the quizzes. Okay, so we're done with A, B, and C. For part D, we know that this is net sales. We know that these were those revenues, interest revenue and rent revenue, except they flipped the order around. So rent revenue is on top, interest revenue is on the bottom. Add these together, we get total revenues, right? Then we get down to our expenses, 90,333. That was our cost of goods sold. $38,628. What is that? That is our total selling expenses. Do we want total in there? Might as well. Total selling expenses. 27,284 is total general and administrative expenses. 3570, that was interest expense. Okay, and so this is our total expenses. And then if we take our total revenues, subtract our total expenses, we get our net income. Again, it should match what we came up with in the multi-step income statement, 283,308. Okay, same answer there. Yay. And we are 7 minutes early. Any questions? No? Okay. All right, well, I'll give you back these 7 minutes. Enjoy. Stay out of the rain if you can, and I'll see you next week. Bye-bye.